Okay, real talk. I want you to imagine something for a second. It's January 2020. A 24-year-old guy named Marcus, first-generation college graduate, just landed his first real job making $58,000 a year in Chicago, finally decides he's gonna start investing. He's been watching YouTube videos, he's been reading Reddit threads, he's pumped, he feels ready. He opens a Robinhood account on a Tuesday night, deposits $3,000, his entire emergency fund, by the way, and by Friday, he's gone all in on a single stock he saw trending on Twitter. By March 2020, when COVID crashed the market, he had lost 74% of that money. But here's the twist. The market itself fully recovered within 18 months. The S&P 500 hit all-time highs. People who just stayed put doubled their money. Marcus didn't stay put. Marcus panic sold. Marcus lost $2,200 and walked away from investing entirely for 2 years. That story is not unique. That story is everywhere. And the worst part, every single mistake Marcus made, every single one, was completely, totally, 100% avoidable. That's what today's video is about. I'm going to walk you through the biggest investment mistakes beginners make, the ones that silently destroy wealth before it even gets started. And more importantly, I'm going to show you exactly how to avoid every single one of them. Whether you have $500 to invest or $50,000, whether you're just starting out or you've been trying to figure this stuff out for a while, this video is for you. So hit that like button, grab your coffee, and let's get into it.
All right, mistake number 1, and this one is sneaky because it disguises itself as wisdom. Waiting for the perfect time to invest. You've heard it, maybe you've said it yourself. I'll start investing when the market calms down. I'll wait until after the election. I'll start when I have more money. The market seems too high right now. Sound familiar? Here's the brutal truth. There is no perfect time. And waiting for one is costing you thousands, maybe tens of thousands of dollars. Let me show you with real numbers. Let's say you're 25 years old. You have $5,000 sitting in your savings account earning basically nothing, maybe 0.01% interest at a big bank. You decide you'll invest it next year. Now, let's compare two people. Investor A invests that $5,000 today at age 25, earns a 10% average annual return, roughly the historical average of the S&P 500, and never touches it. Investor B waits just 5 years until age 30 to invest the same $5,000 under the same conditions. By age 65, Investor A has $452,295. Investor B has $281,024. That 5-year delay cost Investor B over $171,000. They invested the exact same amount. The only difference was when they started. This is the power of compound interest, what Albert Einstein allegedly called the eighth wonder of the world. And it only works if you actually start.
Now, I know what you're thinking. But what if the market crashes right after I invest? Fair question. Let's address it. Here's something most beginners don't know. Time in the market beats timing the market. This isn't just a cute saying. It's backed by decades of data. JP Morgan did a study that showed if you missed just the 10 best days in the S&P 500 over a 20-year period from 2002 to 2022, your returns would have been cut in half. Miss the 20 best days? You barely broke even. The problem? Most of those best days happen right after the worst days. The days you're most tempted to sell or stay out of the market entirely. You literally cannot predict them. Nobody can. So what's the solution? Start now. Start small. Be consistent. You don't need $10,000 to get started. Apps like Fidelity, Schwab, and Vanguard let you start with as little as $1. You can set up automatic investments of $50 or $100 a month and just forget about it. The goal isn't to perfectly time the market. The goal is to get your money working for you as early as possible and let time do the heavy lifting.
Remember, every single day you wait, you're choosing to let inflation eat your savings instead of letting compound interest grow your wealth. Start today. Even if it feels scary, just start.
Okay, mistake number 2, and this one trips up a ton of beginners. Investing before you have an emergency fund. This might sound boring. You came here to learn about stocks and investing, not about savings accounts. But stick with me, because this mistake can completely derail your entire investment journey. Remember Marcus from the intro? His first mistake wasn't the stock he picked. His first mistake was investing his emergency fund. Here's why this matters so much. Life happens. Your car breaks down. You lose your job. A medical bill shows up. Your HVAC unit dies in July in Texas. These aren't hypotheticals. These are certainties. Something will go wrong at some point. The only question is whether you're financially prepared when it does. If you don't have an emergency fund and something goes wrong while your money is in the market, you have 2 terrible options. Option 1, take on high-interest debt, credit cards, personal loans to cover the emergency. The average credit card interest rate in the US right now is over 20%. That's brutal. That completely cancels out any investment gains. Option 2, sell your investments, possibly at a loss to cover the emergency. This is exactly what forced Marcus to sell during the COVID crash. He didn't want to sell. He had to sell because he had no cushion. So what's the rule?
Before you invest a single dollar, build an emergency fund of 3 to 6 months of living expenses. If your monthly expenses, rent, food, utilities, car payment, everything come to $3,000 a month, you want $9,000 to $18,000 sitting in a high-yield savings account that you do not touch. And I want to emphasize high-yield savings account, not a regular savings account paying 0.01%. In 2024 and 2025, high-yield savings accounts were offering 4.5% to 5% APY. That's real money. Your emergency fund should at least keep pace with inflation while it waits. Right now, some of the best options include Marcus by Goldman Sachs, Ally Bank, SoFi, and American Express High Yield Savings. Most of these have no minimum balance requirements, no monthly fees, and you can open an account in about 10 minutes. Now, I know some of you are going to say, but I'm young and healthy. I don't need 6 months of expenses saved. And my answer is, you're right that you might not need it, but you absolutely need to have it. The value of an emergency fund isn't just financial, it's psychological. When you have a financial cushion, you invest differently. You don't panic sell when the market drops 20% because you're not desperate. You can afford to be patient. And patience, as we'll talk about in a minute, is one of the most valuable things in investing. Build the emergency fund first, then invest. In that order every time.
Okay, here we go. Mistake number 3, and this one is going to upset some of you, but I'm going to back it up with data, so stay with me. Trying to pick individual stocks as a beginner. I get it. It's exciting. You hear that someone made a 400% return on Tesla. Your buddy at work bought GameStop at the right time and made $8,000 in a week. There's something thrilling about picking a stock and watching it go up. But here's what the data actually says. Study after study shows that the vast majority of individual investors who try to pick stocks underperform a simple index fund. In fact, SPIVA, that's S&P Dow Jones Indices versus Active, releases annual data on this, and every single year the results are the same. Over a 10-year period, roughly 85 to 90% of actively managed funds run by professional fund managers with teams of analysts, Bloomberg terminals, and decades of experience fail to beat the S&P 500 index. These are professionals with resources you and I don't have, and they're still losing to a simple index fund that just buys everything? So what makes you think that you, as a beginner with limited time, limited data access, and significant emotional bias, are going to outperform the market by picking individual stocks? Here's the really insidious part of stock picking. It feels like skill even when it's luck. You buy 3 stocks. 2 of them go up, you feel like a genius. You invest more. Then one of those stocks drops 60% in an earnings report, and you've given back all your gains and then some. This is what behavioral economists call attribution bias. When things go well, we credit our own skill. When things go badly, we blame bad luck or external circumstances. The most honest thing I can tell you is this.
In the short term, the stock market is largely unpredictable. Even the best investors in the world are wrong a lot. Warren Buffett, arguably the greatest investor of all time, has said he doesn't know what the market will do in the next year.
So what's the alternative? Index funds, specifically broad market index funds. An index fund doesn't try to beat the market, it just is the market. The most popular one is the S&P 500 Index Fund, which tracks the 500 largest publicly traded companies in the United States. When you buy a single share of an S&P 500 index fund, like VOO from Vanguard or IVMe from iShares or FXAIX from Fidelity, you're instantly buying tiny pieces of Apple, Microsoft, Amazon, Google, Berkshire Hathaway, and 496 other companies. You're diversified immediately. You have no single stock risk. And historically, the S&P 500 has returned an average of about 10% per year over the long term. The wealthy don't all pick stocks. Many of them invest in index funds. John Bogle, the founder of Vanguard and the person who invented the index fund, is considered one of the greatest financial innovators in history. His entire philosophy? Stop trying to beat the market. Own the market. Now, I'm not saying never invest in individual stocks. Once you have a solid foundation, your emergency fund, your retirement accounts maxed out, a core portfolio of index funds, then absolutely. If you want to put 5% or 10% of your portfolio in individual companies you believe in, go for it. Use it as a learning experience. But don't start there. Don't make that the core of your strategy. Start boring, start broad, start with index funds. All right, mistake number 4. This is the one that literally costs people hundreds of thousands of dollars in unnecessary taxes over a lifetime, and almost nobody talks about it enough. Ignoring tax-advantaged retirement accounts. If you're investing in a regular brokerage account before maxing out your 401k or IRA, you are leaving free money on the table, period. Let me explain. First, the 401k employer match. If your employer offers a 401k match and you are not contributing enough to get the full match, you are literally turning down free money. This is the closest thing to a guaranteed 50% or 100% return on your investment that exists. Here's how it works. Many employers will match your contributions up to a certain percentage of your salary. A common structure is a 100% match on the first 3% of your salary you contribute. So if you make $60,000 a year and you contribute 3%, that's $1,800, your employer puts in another $1,800. That's an immediate 100% return before the market even does anything. If you're not contributing enough to capture that full match, you are leaving part of your compensation on the table. Go log into your HR portal right now, after this video, and make sure you're at least contributing up to the match threshold. Second, the Roth IRA. If you are under roughly $150,000 in income as a single filer or under $236,000 as a married couple, check current IRS limits, you are eligible to contribute to a Roth IRA. In 2025, the contribution limit is $7,000 per year, $8,000 if you're 50 or older. Here's why the Roth IRA is one of the most powerful investment vehicles available to Americans.
You contribute money after taxes. It grows completely tax-free. And when you withdraw it in retirement, you pay 0 taxes on the gains. 0! Nothing! Not a dime! Let me put that in dollar terms. Say you contribute $7,000 per year to a Roth IRA from age 25 to age 65. That's 40 years, $280,000 total invested. At a 10% average annual return, you'd have roughly $3.1 million at retirement. In a regular brokerage account, you'd owe capital gains tax on those gains every time you sell, up to 20% for long-term capital gains. In a Roth IRA, that entire $3.1 million is yours, tax-free. The difference could easily be $600,000 or more. All because you use the right type of account. Third, the traditional IRA and pre-tax 401k. These work differently. You get a tax deduction now, but pay taxes on withdrawals in retirement. These are excellent if you're in a high tax bracket today and expect to be in a lower bracket in retirement. The key is to prioritize this order. 401k up to the employer match. Always do this first. Max out your Roth IRA, $7,000 per year. Max out your 401k up to $23,500 in 2025.
Then invest in a taxable brokerage account. Most beginners skip straight to step 4. Don't do that. The tax savings from step 1 through step 3 are enormous over a lifetime. Use every tool the government gives you before you start paying unnecessary taxes.
Mistake number 5. And I'll be honest, this one is the hardest to fix because it's human nature. Letting emotions drive your investment decisions. There are 2 emotions that destroy investor returns more than anything else: fear and greed. Let's talk about fear first. When the market drops, and it will drop, sometimes dramatically, the natural human response is panic. Your brain goes into survival mode. The same instinct that told our ancestors to run from predators is telling you to get your money out before you lose everything. This is called panic selling, and it is the single most wealth-destroying behavior in investing. Here's what actually happens when markets crash. The market drops 30%. Panic sellers sell at the bottom and lock in their losses. The market recovers because historically it always has recovered from every crash in American history. The panic sellers either miss the recovery entirely or buy back in at higher prices than where they sold. They literally sold low and bought high, the exact opposite of what you want to do. This happened in 2008, in 2020, in 2022, every single time. The people who did nothing, who kept their automatic investments running, who didn't look at their portfolio every day, came out dramatically ahead. Now let's talk about greed. Greed shows up when things are going really well. When you've made 40% in a year and you start thinking, why am I only in index funds? I should go all in on crypto or meme stocks or options or whatever is hot right now. This is called FOMO investing, fear of missing out, and it's how people turn a really good investment portfolio into a disaster. We saw this with crypto in 2021. We saw it with meme stocks. We saw it with the dot-com bubble in 1999. Every generation has its FOMO moment, the thing that you absolutely cannot miss. And every time, the people who chase that hype end up getting burned. So how do you take emotions out of investing? 3 strategies. Strategy 1, automate everything. Set up automatic monthly contributions to your index funds. If the money gets invested before you even see it, like with automatic payroll deductions into your 401k, you can't emotionally react to it. You're investing on autopilot regardless of what the market is doing.
Strategy 2, don't check your portfolio every day. Seriously, checking your portfolio daily is like weighing yourself 5 times a day while on a diet. The short-term fluctuations are noise. They will stress you out and lead to bad decisions. Check quarterly at most. If you're truly long-term, check once a year. Strategy 3, have an investment policy statement. This sounds fancy, but it's simple. Write down, literally on paper, your investment goals, your time horizon, your risk tolerance, and your strategy. Something like, I am investing for retirement 35 years from now. I will put 80% in U.S. index funds and 20% in international index funds. I will contribute $500 a month regardless of market conditions. I will not sell during market downturns. When panic hits, and it will, you pull out that paper and you read it. It acts as a rational anchor when your emotions are screaming at you. The goal is to be boring. The best investors aren't exciting, they're systematic. They set their strategy, they stick to it, and they don't flinch.
Mistake number 6, investing in things you don't understand. Warren Buffett has a rule: never invest in a business you cannot describe in 1 sentence. It's called investing within your circle of competence. Beginners constantly break this rule. They buy options without understanding leverage. They buy crypto projects based on social media hype without understanding the technology. They put money into REITs or inverse ETFs or leveraged funds without understanding how these instruments actually behave. And then they're shocked when things don't go as expected. Let me give you a quick example with leveraged ETFs, because this one trips up a lot of people. Say you see an ETF called TQQQ. It's a 3x leveraged NASDAQ ETF. The idea is simple. If the NASDAQ goes up 1%, TQQQ goes up 3%. Sounds great, right?
But here's what people don't realize. Leveraged ETFs don't just magnify gains, they magnify volatility decay. If the NASDAQ drops 10% one day and goes back up 10% the next day, you're back to even, right? Not with TQQQ. Day 1, down 10% means TQQQ drops 30%. $1,000 becomes $700. Day 2, up 10% means TQQQ goes up 30%. $700 becomes $910. You're still down 9%, even though the underlying index is flat. This is called volatility decay, and it means leveraged ETFs are terrible for long-term holding in volatile markets, even if the underlying index goes up. But beginners see 3x returns and pile in.
Or take options trading. Options are powerful tools, but they have expiration dates that can go to zero, and the math of how they're priced, Greeks, implied volatility, time decay, is genuinely complex. Beginners who jump into options trading are essentially walking into a poker game against professionals. The rule is simple. If you cannot explain to a 10-year-old how this investment works and how you make money from it, don't put money in it. This doesn't mean you can never invest in complex instruments. It means you need to learn first, invest second. There is a free library of financial education available to you right now. YouTube channels, Investopedia, books like The Little Book of Common Sense Investing by John Bogle, A Random Walk Down Wall Street by Burton Malkiel, The Psychology of Money by Morgan Housel. Spend time learning. The more you understand, the better decisions you'll make, and the less likely you are to be fooled by financial products that look great on the surface but are designed to benefit someone else.
Okay, mistake 7. And this one is invisible, which makes it especially dangerous. Ignoring investment fees. Fees don't sound scary. What's the difference between a fund with a 0.03% expense ratio and one with 1.2% expense ratio? It's barely more than 1%, right? Wrong. Over a lifetime, that difference is staggering. Let me show you the math. You invest $50,000 and earn an average of 10% per year over 30 years. With a 0.03% expense ratio, like Vanguard's VOO, you end up with approximately $859,000. With a 1.2% expense ratio, common with actively managed mutual funds, you end up with approximately $627,000. The fee difference costs you over $232,000 over 30 years for doing literally nothing differently. That's the power of fees, or rather, the destruction of fees. And it's not just expense ratios. Watch out for sales loads. Some mutual funds charge you 3 to 5% just to buy into them. This is outrageous and completely avoidable in 2025. Account maintenance fees. Some brokerages charge monthly or annual fees just to keep your account open. Trading commissions. Most major brokerages have eliminated these, but some still exist, especially for certain asset types. Advisor fees. Financial advisors often charge 1% of your assets under management per year. On a $500,000 portfolio, that's $5,000 every single year. For some investors, a good advisor is worth it, but understand what you're paying. The solution is straightforward. For most beginner investors, stick to low-cost index funds. Vanguard, Fidelity, and Schwab offer funds with expense ratios as low as 0.01% to 0.04%. That's essentially free! Fidelity actually offers zero expense ratio index funds, FZROX, Total U.S. Market, and FZILX, International. You literally cannot do better on fees than zero. Every dollar you save in fees is a dollar that stays in your portfolio and compounds over time. Pay attention to fees. They are the guaranteed drag on your returns. Unlike market performance, which is uncertain, fees are certain. Minimize them wherever possible. Nothing. Start simple. Start now and build from there. Here's the thing about building wealth. It's not about being a genius. It's not about finding the next hot stock or timing the market perfectly or having some inside information. It's about avoiding the mistakes that stop most people from ever getting started. It's about being consistent. It's about being patient. It's about letting time and compound interest work for you. The average American retires with less than $100,000 saved. That's not because building wealth is impossible. It's because most people make these avoidable mistakes, often out of ignorance, fear, or simply lack of a clear starting point. You now have that starting point. So here's your homework. Yes, I'm giving you homework, and I want you to do at least one of these before you go to sleep tonight. Check if your employer offers a 401k match and adjust your contribution if needed. Open a Roth IRA if you don't have one. Set up automatic monthly contributions to an index fund. Move your emergency savings to a high-yield savings account. One action. That's all it takes to start shifting your financial trajectory. If this video helped you, please hit that like button. It genuinely helps more people find this content, and it lets me know to make more videos like this. Subscribe if you want to keep learning about personal finance, investing, and building real wealth over time, without the noise, without the hype, just honest, evidence-based information. And drop a comment below. What is the investing mistake you made that others should know about? Let's build a community here. Your experience might be exactly what someone else needs to hear. I'll see you in the next one.